Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate filings so you don't have to. Today we're diving into Eastman Chemical Company's latest report, and let me tell you, it's a bit like trying to untangle a ball of yarn after a kitten got to it. There are some interesting details, some expected results, and some potential problems ahead. In this report, Eastman shows us a mixed bag. While they've managed to boost profits, sales are slightly down, and they're navigating a tricky financial landscape with debt and some complicated market risks. Let's decode what's really going on. First off, this is a look at Eastman Chemical's performance for the first 3 months of 2025, so it's a snapshot in time. Remember that things in the chemical world, just like any business, can change fast. Let's jump right into the numbers because that's what matters. Total sales at $2.29 billion. While that sounds like a lot, it is slightly less than last year, when their sales were at $2.31 billion. Not a huge deal, but something to keep in mind. Now, here is some good news. Even though sales went down a little, their earnings per share, that is, how much profit they made per each share, you can buy as a stockholder, actually went up. Last year it was $1.58. This means they made more money for their investors, even though they sold slightly less product. Now it's time to talk about cash flow. The company used up $167 million in operating activities. This compares unfavorably against last year, where they only used $16 million, as in 10 times less. That's quite a difference. The increase in receivables means they're selling goods but not getting paid for them as quickly. It's like lending money without interest. Looking at how they're financing things, there was a net increase in commercial paper and short-term borrowings. This year it was $285 million, basically. It means the company is borrowing more short-term to manage its money flow. Now let's talk about what they have in the warehouse. Inventories are up. At the end of March 2025, they had about $2 Vars. 2025, they had about $2 bad, depends on the future. It means they have more products waiting to be sold. Whether that's good or bad depends on the future. In Heiksmud, only had about $1.9 billion. It means they have more products waiting to be sold. Whether that's good or bad depends on the future. Let's talk about taxes, because everyone loves taxes. The company paid $70 million in income taxes this quarter, compared to $49 million the same time last year. That means they are paying a bigger percentage of their money to the government, almost 30%. Now onto our critical part, debt. The company is managing a total debt of around $5 billion. Of that, long-term borrowings make up $4.7 billion. It shows where their obligations are. Their interest rates also matter. Their 5-year term loan has interest rates of 5.55%, which indicates how much the company must pay for its financing. To help navigate their global operations, the company uses something called derivatives, and they're using them to hedge their investments. If we peek into the table regarding financial positions and fair value, we see that they are doing pretty well. Total derivative assets are at $19 million, while total derivative liabilities are at $34 million. To navigate market shifts, the company uses all sorts of financial tools. This quarter, the company entered into fixed-to-fixed cross-currency swaps of $50 million to hedge against any currency exchange fluctuations, which is pretty smart. Companies need to be ready for environmental obligations. Eastman has set aside $282 million for environmental contingencies. It means they expect to have some costs associated with cleaning up or dealing with environmental issues, and they're planning for it. Stockholders' equity is the money that belongs to the owners. Here there was an increase from $5.779 billion from December last year to March 2025. That's a good sign, shows their building value. The section of the report about how much money the company made per share is very interesting, and says that basic earnings are $120.58 versus $1.49. Higher the better. Sometimes company needs to make tough choice to stay afloat. The company's report included restructuring and severance. The severance charges were at $8 million and restructuring charges were at $8 million. What you might find interesting as well is share-based compensation plans. For Eastman, that was about $23 million. It means they're paying a chunk of their employees with shares in the company, and that counts as an expense. Looking at how the different parts of Eastman are doing, we can focus on the adjusted earnings before interest and taxes. The biggest chunk of income here seems to be coming from additives and functional products at $141 million, compared to only $19 million for chemical intermediates. Looking at where Eastman is making their sales, a bulk of their customers are in US and Canada at about $1 billion, followed by Europe, Middle East and Africa at $610 million and then Asia Pacific at 539 million. To sum up the numbers, here's the short of it. Eastman is managing a pretty hefty debt load of $4.7 billion. They also have a decent amount of assets to show for that debt, with a total value of almost $15 billion. One more financial activity is that they sell invoices to third parties to improve cash flow. Amounts sold under the program were 676 million dorans during the first quarter of 2025. Now, shifting gears to the less shiny side, let's talk risks. I want to focus on just a few, but you can dig into the report on your own. Legal proceedings and legal compliance also take a central role. It mentions proceedings regarding a number of claims, meaning Eastman is no stranger to the courtroom. Let's see what the company hopes for the future. These forward-looking statements mean the company is making predictions about what will happen. These include things like new products, global economic conditions, and expected financial results. Just remember, these are educated guesses, not promises. Now, my take, Eastman is walking a financial tightrope. On one hand, they're increasing earnings per share and strategically managing parts of their debt. On the other, sales are a bit wobbly and they're leaning more on short-term borrowing. On the bright side, Eastman's increasing equity reflects growing financial muscle with earnings and careful handling of compensation plans. A significant watch out, those economic risks and legal battles, changes in global trade, or a major legal defeat could really throw a wrench in their plans. Bottom line, Eastman is in a decent position, but they need to be careful about costs. Keep an eye on how they balance debt with growth, because that will be the key to their long-term success. That's all for today's Corporate Decoder. If you found this breakdown insightful, please give us a thumbs up, drop a comment, and subscribe for more deep dives into the world of corporate finance. Until next time, stay informed.